Hey, what's going on, all my winners out there? Hope you guys are having a wonderful day. Today, I wanted to give you guys a quick little video on stocks. So I've been getting some great feedback and questions about stocks on my Instagram channel, which if you are not following me on Instagram, it is at winwithryan. Also sign up for the newsletter at winwithryan.com. So anyway, hope you guys are having a wonderful day. I'm going to go ahead and shoot just a quick video, super simple, straight from Investopedia, so you can see what a stock is, how it works, and why people buy and use stocks. All right, hey everybody. So we're going to go ahead and jump right in to what is a stock. So for those of you guys that know, this channel is all about financial and surfing. So the goal of this channel is to be able to work online through investing and be able to surf the world and really utilize that. So what we're going to talk about today is stocks. This is a passive income source. So once you invest in stocks, it's a way of making money without actually having to do anything. You just have to pick the right stocks. And we're going to talk about what a stock actually is on the Instagram channel over at Win with Ryan on Instagram, at Win with Ryan on Instagram. We've been getting a couple of direct messages talking about what exactly is a stock, what is the Forex market, and so on, which we've talked about in previous videos. So if you're not following me on Instagram, feel free to do that. Also, don't forget to like and subscribe this video as well. Hit subscribe there so you don't miss up any of our upcoming videos. So we're going to go ahead and jump right in. This is straight from Investopedia, so that way you guys know that the information that you're getting is the simplest and easiest way. That's the best way I can explain a stock is this right here. So what is a stock? A stock, also known as equity, is a security that represents the ownership of a fraction of a corporation. This entitles the owner of the stock to a portion of the corporation's assets and profits equal to how much stock they own. Units of stock are called shares, right? So for example, if you owned a company, and we can call it Win with Ryan. Win with Ryan is a company, and let's say that I wanted to issue 100 shares and you bought one of those shares at whatever price it was, you would own 1% of that company. Now the amount of shares per company varies, so we'll continue on, all right? Stocks are bought and sold predominantly on stock exchanges, though there can be private sales as well, and are the foundation of many individual investors' portfolios. These transactions have to conform to government regulations, which are meant to protect investors from fraudulent practices. Historically, they have outperformed most other investments over the long run. These investments can be purchased from most online stockbrokers. Stock investment differs greatly from real estate investment. So we do talk about both on this channel. I also do want to let you guys know where I get my stocks from. I do currently use Webull. Webull is an online platform that you can use to purchase stocks very, very simply. I will go ahead and post a link down below for Webull as well. If you sign up with Webull, they give you 2 free stocks, and once you put some money into your account. Now, I'm all about maximizing my free stuff as well on this channel because we want to be very frugal and also make as much money as possible so we can have that freedom that we desire. So I do also have a Robinhood account. Robinhood is the same exact thing where you can buy stocks and you can track them on your phone as well as online, as you can see here. I also will provide a link for the Robinhood account down below. What's really cool about both these accounts, they do provide free stock, right? So let's say you were about to invest $500 worth of stock. Well, you could do $250 in Webull, $250 in Robinhood, and now you have free stocks coming to you as well. With the free stock disclosure here, free stock offer is available to new users only, subject to terms and conditions at Robinhood free stock. Free stock chosen randomly from the program's inventory. All right, so we will add 1 share of free stock to your account when you fulfill the conditions of the promotion, and you'll be able to keep the stock or sell it after 2 trading days. Who do they choose, and so on. You can go through and check all of this out. All right, so I just wanted to let you guys know that is option for you guys. So I wanted to give that to you as a thank you for following the channel, you get 2 free stocks for signing up to those as far as that goes. So key takeaways: a stock is a form of security that indicates the holder has proportionate ownership in the issuing corporation. Corporations sell stock to raise funds to operate their businesses. There are 2 main types of stock: common and preferred. Stocks are bought and sold predominantly on stock exchanges, though there can be private sales as well, and they are the foundation of nearly every portfolio. Historically, they have outperformed most investments over the long run. So, understanding stocks. Corporations issue or sell to raise funds to operate their business. So, for example, you hear about these things called an IPO, right? An initial product offering. Well, if my company, Win with Ryan, comes out with a new product, let's say a new surfboard, and it's a surfboard company that we're going to build, but in order to really get the funds going to scale it to massive proportions, I would then offer options to buy stocks to people. And then those people would actually buy the stocks, they would own a percentage of the company, and then I, as the owner of the company, would use that money to invest back into the company to keep the growth going. All right, so corporations sell to operate their business. The holder of stocks, a shareholder, has now bought a piece of the corporation, and depending on the type of shares held, may have a claim to a part of its assets and earnings. In other words, a shareholder is now an owner of the issuing company. Ownership is determined by the number of shares a person owns relative to the number of outstanding shares. So for example, if a company has 1,000 shares of stock outstanding and one person owns 100 shares of that, that person would own and have claim to 10% of the company's assets and earnings. Stockholders do not own corporations, they own shares issued by the corporations. But corporations are a special type of organization because the law treats them as a legal person. In other words, corporations file taxes, can borrow, can own property, can be sued, etc. The idea that a corporation is a person means that the corporation owns its own assets. A corporate office full of chairs and tables belongs to the corporation, not to the shareholders. This distinction is important because corporate property is legally separated from the property of shareholders, which limits the liability of both the corporation and the shareholder. If the corporation goes bankrupt, a judge may order all of its assets sold, but your personal assets are not at risk. The court cannot even force you to sell your shares, although the value of your shares will have fallen drastically. Because if your company, let's say that your company is worth $100 per share, and then your company goes bankrupt, well, now your company's not worth $100. It might be worth $1 per share, $10 per share, as far as that goes. Likewise, if a major shareholder goes bankrupt, she cannot sell company's assets to pay off her creditors. Stockholders and equity ownership. With shareholders actually own our shares issued by the corporation, and the corporation owns the asset held by a firm. So if you own 33% of the shares of a company, it is incorrect to assert that you own 1/3 of that company. It is instead correct to state that you own 100% of 1/3 of that company's shares. Shareholders cannot do as they please with the corporation or its assets. A shareholder can't walk out with a chair because the corporation owns that chair, not the shareholder. So this is known as the separation of ownership and control. Owning stock gives you the right to vote in shareholder meetings, receive dividends, which are company's profits, if and when they are distributed, and it gives you the right to sell your shares to somebody else. If you own a majority of the shares, your voting power increases so that you can indirectly control the direction of a company by appointing its board of directors. This becomes most apparent when one company buys another. The acquiring company doesn't go around buying up the building, the chairs, the employees. It buys up all of the shares. The board of directors is responsible for increasing the value of the corporation and often does so by hiring professional managers or officers, such as the Chief Executive Officer, also known as CEO. For most ordinary shareholders, Not being able to manage the company isn't such a big deal. The importance of being a shareholder is that you are entitled to a portion of the company's profits, which, as we will see, is the foundation of a stock's value. The more shares you own, the larger portion of the profits that you get. Many stocks, however, do not pay out dividends and instead reinvest the profits back into the growing of the company. These retained earnings, however, are still reflected in the value of the stock. Common stock versus preferred stock. There are two main types of stock, common and preferred. Common stock usually entitles the owner to vote at shareholders' meetings and to receive any dividends paid out by the corporation. Preferred stockholders generally do not have voting rights, though they have a higher claim on assets and earnings than the common stockholders. For example, owners of preferred stock, such as Larry Page, receive dividends before common shareholders and have priority in the event that a company goes bankrupt or is liquidated. All right, so fast fact, the first common stock ever issued was the Dutch East India Company in 1602. So companies can issue new shares whenever there is a need to raise additional cash. This process dilutes the ownership and rights of existing shareholders, provided they do not buy any of the new offerings. Corporations can also engage in stock buybacks, which would benefit existing shareholders as it would cause their shares to appreciate in value. Stocks versus bonds. So stocks are issued by companies to raise capital, paid up or share in order to grow the business or undertake new projects. There are important distinctions between whether somebody buys shares directly from the company when it issues them in the primary market or from another shareholder on the secondary market. When the corporation issues shares, it does so in return for money. Bonds are fundamentally different from stocks in a number of ways. First, bondholders are creditors to the corporation and are entitled to interest as well as repayment of principal. Creditors are given legal priority over the stakeholders in the event of a bankruptcy and will be made whole first if a company is forced to sell assets in order to repay them. Shareholders, on the other hand, are last in line and often receive nothing or mere pennies on the dollar in the event of a bankruptcy. This implies that stocks are inherently riskier than investments and bonds. Now, the other thing about stocks too is the whole point of this, if you were paying attention properly, right? So stocks, you buy companies that you expect to do well. So for example, you have Win with Ryan. It's already doing well. We're making progress. We're growing as a company. You invest into my company. I take that money that you're investing and the goal, I invest that into marketing. I invest that into resources to grow the company. So let's say that our company was worth $1 million right now, and your investments, you buy some shares, we use that and we grow the company to $2 million. The price of the stock that you bought it when we were worth $1 million is now worth significantly more because our company is worth $2 million, which is really exciting. So that's why you're seeing these companies like Apple, Google, Amazon, their stocks just keep on going up because their revenue, the amount of money that they're producing, keeps going up. Now there's other stocks out there that are going down. That's because their company, their business model is not doing well. Like for example, right now with the COVID thing, we have a lot of different stocks that are tanking, right? Like the travel industry is not doing very well and so on. But other industries that are beneficial to staying at home orders and so on are increasing. So I hope that gives you more details of what a stock is. In upcoming videos, I'll do a detailed what a cryptocurrency is, because cryptocurrency is blowing up again. We've been on cryptocurrency since 2016. We went through the ups and then the complete downs, and now we're going all the way riding it back up, which is really exciting. So I hope you guys are having a wonderful day. Don't forget to sign up for our newsletter at winwithryan.com. Talk to you guys on the other side. Don't forget to like and subscribe to the channel as well. Have a wonderful day.